equity, hybrid, and this, right? So read out the names here. See, money market fund, liquid. Is it? Okay. So short duration, long duration, low duration, all these things will be there. So in that again, as I told you, even arbitrage, all these floater funds, there are, I mean, multiple types of fund. Yes, as you told, top three are equity, debt, and hybrid. Uh, okay. So now to consider what is equity. Okay. So question was Tadaki that which one to invest and what is the difference? So which has highest returns and which has risk. Uh, okay. So what does the name equity say? In simple terms, not to make it complicated, equity is nothing but shares of the company. For example, now in what mutual fund is in normal terms, what mutual fund does is, if you give it 100 rupees, okay, my handwriting is really bad today, I'm sorry for with this trackpad. So if you give, so for 1,000 rupees, for example, if you give, so in that they will give some part of to it at every share value. If I go to any one of grow, I will go to grow without grow. So mutual funds without even registering, can I go now? Hey, please don't ask me to register. I don't want to. Huh. Explore mutual funds. So if you go here, no, see. So if you go to any fund, and here if you go and search, okay, no, not peer comparison, holdings. So what are holdings? Holdings are the number of shares or percentage of shares that a fund is being invested. So how mutual fund works? Okay, uh, 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 let's keep it simple. So what you do, you give 1,500 or 2,000 rupees to that fund company to say that you invest on my behalf, and they will charge a very small amount of money for the research. Now you'll say they might charge only 10 paise or 1 rupees, that is negligible. Okay. But when you see at a very big scale, so now if you say you are the only person who is giving 2,000 rupees or 3,000 rupees, like that, if 2 lakh or 3 lakh people are giving, so for every fund, they are already getting some extra 0.1% or 0.01% of money, okay, which they are using for their research and all. Okay, so now why mutual fund do we choose? First thing, we'll start from the start. Why do we choose mutual fund? So mutual funds are chosen by people, or majorly by the people who don't know much about, or don't have time to invest to in their research and find the stocks which are good or which are bad. Okay, so here what they do is they find an expert, which is the fund manager. Fund manager is a person who does the research on your behalf, and then puts your money in that company or buys the share of that company. Okay, here what happens, for example, if you are giving some lump sum amount of money, there are many people again giving some lump sum amount of money. He decides that Infosys, for example, Infosys and TCS have huge growth potential here. So what he does, he puts maximum amount of money, and then he then decides where all he has to put the money extra. So this again, he can change over the period of time with his understanding or with his research. But then what what the sum is, you do not have time or you do not have the expertise to do this research and find out all these stocks and then invest. Instead, what you do, and one more thing. So if you have to buy one TCS, I think it was around 3,000, 3,600, 3,700. In 1,000 rupees, how can you buy? Correct? No. So in this case, what happens? They take all this money, and as it is a lot of money from not just from you, it is from all other people around. So what they do is they take the money like this, and then based on this percentage, they again buy the shares, and then they keep it in your account. So the percentage of share, usually in India we do not have the concept of percentage shares, but then as the with these funds, there is a possibility, but it would be in terms of quantity. If you see what is it called? I forgot the name. NAV. So this NAV is nothing but the price of this total complete fund, the amount, the complete value of these companies divided by some value. Okay. Now I'm not going into depth because that would take a lot of time again to explain. If required, ask me. I'll surely explain that. But then after this, if you see now what you're doing, you're investing at this value. Correct, no? If you have seen mutual fund, every time or every month or every week or every fortnight when you buy, you invest at that current NAV. That means what is the price at this, I mean, of that fund at that day. And this increases and decreases based on the price of these companies. If you see, they have also invested in US, Amazon dot inc .com.in. So I mean that you don't usually see that they are investing outside, but then you can see where they are investing. If you see Alphabet is Google. Again, if you see no, there was one more thing. Amazon and there was one more. Microsoft. So all these companies are not from India. Cognizant. So these are foreign countries. If you see foreign equity, foreign mutual fund equity. So all these are again diversified. What is diversified again? You cannot you should as it is a very big saying that you should not keep all your eggs in one basket. So they keep it in different markets. So wherever the growth is, it reflects here all over. So if your fund if to, all the shares grow, your NAV value will grow. Your NAV value grows, then ultimately you will have some good amount of profit at the end of the day. Now, what is equity? Equity is nothing but shares. Okay. And what is debt? Debt is kind of, as the name says, it is kind of loan. So where do you in very simple terms, where do you get more returns? In debt or in equity? I mean, by giving a loan or by buying an equity in long term, I'm saying. On the same terms, which has higher risk? Correct. So share price can even go zero, can even go very high. But then on the debt side, it again depends on which how much how many companies and how much of the loans have been provided for anyone. So that is fixed. It can vary somewhere around 5%, 10%, 15%, 20%. It can vary at any point. But then that is little bit on a secure side. So that, but the returns are low. Hybrid is again, if you say mix of both. If you go to hybrid, yeah, both the plus points would be added, but the returns would be less than equity, higher than hybrid. Sorry, higher than debt, but the risk would be also similarly matched. So no, you are not buying it. So what happens? See, the companies also, and also see in equity, no, why I'm saying the risk is high. So if I go here. Mhm. So in last 3 years, if you see, we'll go to last 5 years. Okay. So this is a direct growth fund. Growth fund is nothing but wherein we will we'll give it into equity. See, if they say is very high, very high. Okay. And they'll give it into equity. And hey, what happened? Issues bonds. Okay. Bonds is nothing but you are giving, for example, or if I have to say in simple terms, you'll say I'll give you 10 lakh rupees. You have to give me bonds. So that is the written statement saying that I would give you 6% or 7% of money back when you give me these bonds back when I buy back of these bonds. So at for example, not everyone is very much open to go and invest in shares. And also, companies also want in loans or want money at very low interest compared to banks. So this is one, apart from equity, this is one of the other options wherein they give out their bonds. So bonds are nothing but a written statement wherein it provides you how much amount of money or how much interest you will be paid, and over the period of time, how much money they'll give back when you're selling your bonds back to them. So For 10 lakhs, if you say, I would give you yearly. So again, this might vary. So every year the corporate bond value varies, but then some stays very what do you say, um, very low, or some stay very stagnant. But it does not vary like equity, like someday 50%, someday 60%. No, it is a very stagnant one and low risk one. So bond means you are not giving the loan. What you're doing is you are giving your money to the mutual fund manager. He is deciding in which bond as in which company I should invest with least of risk. So this is the other way of it. Not only bonds, there are different things also, but then bond is one of the major ones. How apart from these new loan frauds, how many of you remember that people do not pay loan back? At least companies, which big companies do not pay loan back. Few, right? Few, right? But in equity terms, how many companies? I mean, you are very new, so how many companies do you really know that went to 10,000 and came back to 1 rupees again? There are also many companies there. And also, see, in equity, no, why I'm saying the risk is high. So if I go here. Mhm. So in last 3 years, if you see, we'll go to last 5 years. Okay. So this is a direct growth fund. Growth fund is nothing but wherein we'll give it into equity. See, if they say is very high, very high. Okay, and they'll give it into equity. And hey, what happened?